Welcome back, everyone, to the first module in our final course in the Tools of the Trade curriculum. We've learned about supply and demand, buyers and sellers, support and resistance. Well, today, we're going to take a look under the hood into what really drives price action. Having actively traded the cryptocurrency markets over the last 5+ years, I've developed my own school of thought to explain where all that volatility that we traders love actually comes from. It all relates back to liquidity, and that's why I aptly called it Liquidity Theory. So let's jump right in, shall we? There are 4 main principles on which liquidity theory was founded on. First, trading is a zero-sum game. Well, what do we mean by that? In order for a market to trade, we need exactly 2 participants, a buyer and a seller. That means for every buyer, we need to have a seller in order to transact. Well, the same goes for winners and losers in the market. A zero-sum game states that for every winner, there's a loser. Now, there may be more absolute losers and fewer winners, but the sum output of the game is effectively 0. The market is essentially a means for redistributing capital between these market participants, and that's why we call it a zero-sum game. No new wealth is being generated within the market. Capital is simply shifting hands. Great. Now that we understand the first principle, let's move on to number 2. Principle 2 states that market participants are inherently predatory. This means that the interaction between buyers and sellers is rarely passive. It's an aggressive exchange where one side is constantly trying to outsmart the other. I like to relate it to a video game where there is a perpetual war going on between the 2 parties. Battles are constantly fought at different support or resistance levels, and winners emerge as certain levels give way. This is where predatory behavior is exhibited. Larger players on both sides will often use different strategies to try to pressure the other side to close their positions. Sometimes they even do so by sourcing momentum from their own side. By successfully doing so, they are rewarded with price going in their favor and subsequently profiting. Ultimately, however, the war never ends. New battles are fought at new levels and victors come and go. This leads me to the third principle. Buyers and sellers participate in game theory. I'll get to game theory in a little bit, but I want to touch on the fourth principle first. Price gravitates towards the area with the most liquidity. Now you're probably asking yourself, well, what is liquidity? So let's take a minute to define it first. Market liquidity is defined as the ability to buy or sell an asset without causing a significant change in price. In trading, this is known as slippage, which is effectively the difference between the expected trade price and the price at which a trade is actually executed. Remember how we talked about market orders in the previous course? Well, a market order guarantees execution, but does not guarantee the execution price. If you market bought a position in Bitcoin when the price was at 8,000, your order may not actually get filled on the books until 8,050. That $50 increase is effectively what we call slippage. So as it relates to trading, we define liquidity as areas where positions can be filled with minimum slippage. Remember, some market participants will be very large players who have intentions of filling very large positions in nominal terms in order to become active players in the market. As we go through this module, we're going to learn about the different ways these players go about filling those positions. The important thing to remember is that large players, just like us, don't want to suffer that $50 in slippage in either direction. It's this understanding that forms the premise for liquidity theory. Now that we have a thorough understanding of liquidity, let's shift gears back for a minute and dive into game theory. Game theory is essentially a theoretical framework for modeling strategic interactions between competing players, given a set of rules and outcomes. The two key premises include that players are rational and will always try to maximize their outcome. If we relate it to liquidity theory's understanding of our buyers and sellers, this will make a lot of sense. Both sides are constantly exchanging with one another, trying to profit as much as possible. We know the rules of the market, and we know that the outcome is eventually zero sum. Therefore, understanding the market conditions help us predict potential outcomes for both sides. This is where identifying liquidity comes into play. If we start to think about liquidity in relation to the market's trend in current price, we start to apply the fourth principle to our analysis. By understanding the buy versus sell side pressure, we are able to capitalize on the participant's behavior and formulate the highest probability scenario. Price gravitates towards the area with the most liquidity. If there's pressure to be exerted on one side of the market, price is likely to react by moving in that direction. Ultimately, this adds confluence to our technical analysis and allows us to trade positions with conviction. Of course, markets are sometimes irrational, and one player's stop loss can just be another player's liquidity. The key to remember is that since trading is a solo sport, every player will try to maximize their own equity curve in the long run. Buyers and sellers may work with other buyers and sellers at certain times, but realistically could care less what others are doing. This is why it's important to start gamifying your analysis of the market. The purpose of the market is to redistribute wealth from the many to the few. That is the most practical application for liquidity theory. We know the game is zero sum and that each participant only has their best interest at heart. We can then use this theoretical understanding to start questioning the market and intellectually determining where is the liquidity. It's always a contextual question. The liquidity on an hourly chart will not be the same as a daily chart and vice versa. This is meant to get your mind thinking about possible scenarios. What is the obvious level others might be looking to buy or sell? How might a larger player capitalize on that knowledge? What is the maximum pain scenario? What I mean is, how can the market redistribute wealth from the many to the few by shifting hands with things like stop runs and liquidity pools? The answers to these questions ultimately create volatility in the market. Stop runs cause slippage, which creates volatility. Thinking about how pressure builds against a market participant as price goes against them. As you gain experience, you'll learn to identify this pressure and the power of control that goes with it. Now that we have a thorough grasp of liquidity theory, in the next video, we'll start to look at different ways of identifying liquidity on a chart. Thanks for watching, and I'll see you soon.